Stock market. This is the second part of stock market. Let's revisit what we've talked about so far. So far we've understood the function of stock markets and looked at some of the drivers of stock prices, such as price to earnings ratio, dividend yield, etc. Now in this particular presentation, we'll talk about what else drives the theoretical price of stocks. And so we'll basically go on to deduce the theory of rational expectations and the efficient market hypothesis. So let's plunge into the last time what we discussed. We talked about the pricing of stocks, in which we said let's use the 1 period valuation model and buy a stock for 1 period and sell it. So the price today will be the dividend we receive at 1 year plus the price we receive at 1 year divided by 1 plus rate, which is defined here as K subscript E to the power of 1. So that's the price today. Now this is just for 1 period. If we make it for multiple periods, in fact, if we receive multiple dividends over multiple periods, such as n periods for theoretical purpose, then we can lay out these cash flows as follows. So the price today is the sum of present value of each of these n cash flows. So the first cash flow is D1, second cash flow is D2, etc. And after n periods, after having received each of these D's, which are the dividends, we sell the stock and receive a price Pn at n period. And therefore, using the usual discount factor analysis, we discount it by the rate. So this is the rate to the power 1, 1 plus rate to the power 2, 1 plus rate to the power n. Notice there are 2 cash flows associated with the last cash flow, kind of similar with what we get in terms of bonds, except that in stock, we don't really have to sell the stock after n periods. In case of bonds, when the bond expires, we have to get the face value back. In the case of stocks, we don't know what we'll get at the end of nth period. Okay, however, we can write this in a much more compact fashion, which is the price today is a sum of t going from 1 through n, which is taking care of these dividends of dt, divided by 1 plus ke to the power t, where ke is that discount rate once again. Since the price that we receive after the nth period is a one-time thing, it is not really operated by the summation operator. Moving on, if we can drag this to infinite period, then we don't have the option of selling the stock. So Pn, really, there is nothing like Pn. In other words, we just have the infinite dividends that we keep receiving. So this is exactly how a stock is priced. So there we go. T equals 1 through infinity of dt divided by 1 plus rate ke to the power of t. T going from 1 through infinity. That is the price today. Okay. What if dividend were to grow? So let's assume today's dividend is D0. And then after 1 year, the dividend would be today's dividend times 1 plus g, where g is the growth rate of dividend. So what would the D2 be? Well, D2 would be D1 times 1 plus g, or we know that D1 is D0 times 1 plus g, so there are 2 1 plus g's, or 1 plus g to the power of 2 squared. That's how we get D2. Can we use induction to find out what is Dn? Sure. Or dt. Dn is D0 times 1 plus g to the power of n. And we can do this for infinite periods. Now, first we can apply this to the n period pricing of stocks by simply replacing each of these dividends, D1, D2, through Dn by D0 times 1 plus g to the power appropriate power. Here is the appropriate power. So we have D0 times 1 plus g for D1, D0 times 1 plus g squared for D2, and so on. And again, if we assume infinite cash flows, then this Pn term goes away. We just have the Dn terms. But again, it's not n cash flows, it's infinite cash flows. Now notice something strange here. Well, the power of 1 plus growth rate of dividends is the same as the power of 1 plus discount rate of the stock. So these two powers are same. So in other words, we can replace this with a common factor. And we call that common factor as R. In other words, we can say P0 is D0R. Let's go back. So D0R, D0R squared, D0R cubed, and so on, infinite terms. That's it. D0R, D0R squared, etc. Looks like a geometric progression, isn't it? And the condition to add the geometric progression, which is infinite, is that the common ratio R should be less than 1. So if we assume R is less than 1, then we will have P0 is D0R divided by 1 minus R. D0R divided by 1 minus R. In other words, D0 divided by 1 over R minus 1. And 1 over R minus 1 is 1 plus KE minus 1 minus G divided by 1 plus, 1 plus G. So it's KE minus G divided by 1 plus G. KE minus G divided by 1 plus G. So P0 is D0 1 plus G divided by KE minus G. The derivation is not that important. What needs to be noted here is that the growth rate is both in the numerator and the denominator. Oh, wait a minute. D0 times 1 plus G is D1. So we can say it's D1 divided by the discount rate minus the growth rate. So what is the condition when R is less than 1? Well, G has to be less than KE. If G is more than KE, this thing will blow up. Negative, basically, which will basically mean nothing intuitively. So this model is called Gordon's growth model. What are some of the effects of Gordon's growth model? Well, as we know, this is the Gordon's growth model. P0 is D1 divided by 1 minus R. And so D1 divided by 1 minus KE minus G. If the Fed lowers interest rate, the discount rate will decrease. That rate there will decrease, decreasing the denominator and increasing the price of stock, because denominator down, the whole thing up. Second, effect of recession. During a recession, recessions are typically, demand side recessions are typically associated with deflation. So when there is a recession, there is a deflation, growth rate of stock cash flows or dividends will decrease. In other words, G decreases. So if G decreases here, K minus G will increase and the numerator will also decrease. But since K minus G decreases, wait a minute, G decreases minus G increases, the denominator decreases. And since G is, G decreases minus K minus G, since G decreases, well, the whole thing will increase and the fraction will decrease. So because of G1 plus G, the whole thing is decreasing, and because of KE minus G, in the denominator, there is no problem. So G is decreasing, the thing will increase, but it's in the denominator, so the whole thing will decrease. In other words, as G decreases, P0 decreases. Okay, now can we apply this to the financial crisis? The 2008 financial crisis was one of the worst bear markets in the last 50 years, and everything was revised downward. So the growth rate of dividends, G, was revised downwards. And as we just saw, a lower G will lead to a lower stock price, and therefore it led to a fall in stock prices and stock indices. Now let's move on to theory of rational expectations. We have already known that economic agents behave rationally. So there are two types of expectations. One is an expectation given all the information right now, and then there is an optimal forecast which considers all of this information and builds a price of stock based on Gordon's dividend model. So this is a theory of rational expectation. Its implication is the forecast error given today's information will be zero. and that is called the efficient market hypothesis, according to which, given any amount of information for a particular stock at this point, will be used inside the cash flow model that we saw in the previous slide to deduce a correct stock price. In other words, the stock price reflects the true availability of information and considers that in the pricing of the stock. Okay, so there are two types of expectation of price of stocks. So XE is the expected value of that price, and XOF is the optimal forecast value of the price. Now, instead of price is a nominal number measured in dollars, and we can use returns. Now, what is a return? According to the efficient market hypothesis, we'll define return at time t equals 1, sorry, t plus 1 is the price at that time minus the price at the previous time period plus any coupon that was received divided by the price at the previous time period times 100. So essentially, if you look at the numerator, it is the profit you make from selling a stock after buying it at a particular price in the previous period plus any dividends that you received or coupons in the case of bonds. So this is the return at the end of time t plus 1. Now, this is the actual return. What is the expected return at that time? Well, expected return is everything is the same because we already know today's price and today's coupon or dividend. We have to expect a certain price at the end of period t plus 1. So the expected return is a function of the expected price, and if the efficient market hypothesis holds, because we have all the correct information available at a given point about a stock, its expected price at t plus 1 is the same as optimal price, which includes all the available information inside it at the same time t plus 1. In other words, because these two expected and optimal prices at t plus 1 are same as each other and PT and C are known, well, these two returns should be equal. So expected return at time t plus 1 and optimal forecast return at time t plus 1 should be the same if efficient markets hypothesis holds. So when the price is, let's say the price is too low. When the price is too low, the expected return is too high. How? Let's see. And let's just assume that for now, for a minute, expected return is too high, which means that optimal forecast return based on today's available information is low as compared to the expected return. So what's going to happen? So let's define return again. This is the expected return. R bar is PT plus 1, that is a price at the end of period t plus 1, minus today's price. We don't control t price at the end of t plus 1, but we do control today's price. So minus today's price, P bar, plus coupons or dividends, if any. So basically this is the amount of money in profits and dividends that we get at the end of the first period, divided by P bar. So that is because we divided by P bar, it gives us a return. Okay, now we know that this P bar is going to be too low to make R bar too high. If P bar is too low, this is minus P bar, so numerator is going to increase. And P bar is the denominator and it's too low, it'll increase a whole fraction. Okay, so the numerator is high and the denominator is low, meaning R bar is too high, which is what the comment here is. Okay, so when well, let's just think about it. My optimal forecast is less than my R bar, the return. Oh, okay, let me build my optimal forecast further. And in such a way that that optimal forecast will start rising towards R bar, and at equilibrium, optimal forecast will be equal to R bar. Now, how can we make this optimal forecast start rising? Okay, well, R bar is too high, so what do? Well, we start buying today. So when we start buying today, the price starts going up from P bar to PT. So when PT goes up, our bar starts decreasing. If R bar starts decreasing, so this R bar was higher as compared to optimal forecast. Now it starts decreasing until it reaches the value of optimal forecast return. So hence what we've shown is that in case of any misalignment of price and returns with the optimal forecast, arbitrageurs will start buying or selling in order to increase or decrease the R bar until it reaches a value of R optimal forecasted. To conclude, efficient markets are where expectations are rational. Any new information for a stock will be instantaneously priced into that stock if the market is open, and we'll try to price it even after hours. So this is the efficient market hypothesis. Can there be a bubble? Yeah, sure. Efficient market hypothesis says it's possible. And a burst of that bubble? Yes, of course. So it's predicted by efficient market hypothesis. It's just that the optimal forecast is not being able to reach the R bar soon enough. This therefore opens the door for us to understand that there can be dramatic changes in stock price and hence optimal forecast for firm valuations for stock prices. And that means in the short run there could be violent moves in certain stocks due to the market just waking up to some reality about that stock. And that is chapter on stock markets. Thank you for listening.